This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil. Welcome back. So what I'm going to do today is discuss a little bit about how to simplify. As many of you know, I have been providing stock research and consulting to institutions for the past 35 years. And one of the things that comes across in this channel is that this is a master's class. This is not necessarily for someone new to technical analysis. However, I don't want to give you the impression that you got to learn all of these crazy things. I think we can do it and start out in a simple manner. And I want to show you something today that I think comes across as fairly simple, but if you use it, it's much more sophisticated than the majority of the people are using. All right, let's get into it. First, I do want to mention some of these techniques, and a lot of what I talk about in multiple time frames, especially with indicators, is in my book. You can go to rabilstockresearch.com/book for more information. Okay, so I talk a lot about indicators, and I do think indicators make life so much easier. However, and what I talk about in my course is that you got to learn price, structure, and simplify things first and understand that by itself before you start adding into indicators. Indicators just make life a little bit easier, but I want you to be able to see these things without indicators first. All right, so the only indicator I've got up on a chart is this 18MA, and I've got a monthly in the bottom left, a weekly bottom right, a daily chart in the upper right, and an hourly in the upper left. All right, now what I want to do is explain how I think if you can find this pattern, you're going to locate yourself in stocks that have a very, very high probability of moving in your favor. All right, and again, I don't have anything up but besides this one single moving average. And I think if you can start here, your chances of success are going to be a lot greater. All right, so let's just start and show what has taken place here. First thing, we always start with the higher time frame and then we work our way down to the smaller time frames. All right, it doesn't work the other way. I know in a lot of cases what you would do at a reversal, if a stock is reversing from a bottom, it's going to reverse in the small time frame first, and then it's going to go to the daily time frame. So the hourly goes to the daily, then to the weekly, then to the monthly, and that can happen. But when we're in a trend, if we're trying to play a trend trade, especially as a pullback, we want to go the other way. We want to start with the monthly and work our way down to the weekly, then to the daily, then to the hourly. All right. So I want you to think in this fashion. All right. Almost like if we did this is, that pi sign, right? I mean, you want to think in those terms. You want to be going in that direction. All right. So let's just look at what's taken place here. So we get a move to the upside. We get across the 18. This is in 2023. We get across the 18-month line, and that line starts to rise. And then we pull back and we hold that, and we turn up from there. So we've made our first higher low. Okay, so we make a move off the low, we hold the 18, and we turn up. In a lot of cases, when you hold the 18, it's going to be your first higher bottom. All right. Now, you might call this a little, to me, this isn't a true higher low, and not in the form that we're trying to find. We're trying to find something that has a potential for trend change. So we want to look for the location is typically at the first time the 18 is turning up. All right, so we get that pattern, we get that to take place. Now I'm going to switch this so you can see when if you look at the crosshair, when I look at that where that's making the higher low, that's right here, right before this big green bar right here on the weekly chart. All right. So if I locate that, that's right there. All right. And that's essentially right here. Now, if you notice, we're crossing above an 18 on this time frame. So we cross above the 18 here and we pull back. Now we're looking for the crossover, have this turn up and look for a pullback. All right. Now we make our higher low here. All right. So now we've done that in 2 consecutive time frames. Do you see how that just took place? Now, look, if I see the volume pattern, I'm going to feel a lot better about this. You see, that's another indicator. All right. I'm not saying that you have to do that, but if we didn't have really good volume here, I probably wouldn't be quite as interested, or if I didn't have good momentum in the play. But you can see that with the bars. You can see the big green bar here. and you can see the strength that created this separation from the 18 before you pulled back. Same thing here. We created some separation before we pull back. But now let's look at this. So here, let me go again. Now, let's say we make our higher low. Now look at where that shows up on the daily chart. That's right here. All right. So as this is making a higher low, we now are crossing above the 18 on this time frame. But look at what happens. The 18 starts to cup around and pull back, and we make our higher low here. All right. So now we've done the exact same thing on 3 consecutive time frames. We've moved up and we've pulled back, and we're holding the 18. We've moved up and pulled back, and we're holding the 18. We've moved up and pulled back, and we're holding the 18. Now, if you notice, it happened first on this time frame, second here, and then third here. It wasn't. So this is the process I want you to think about. We want it to happen on the bigger time frames first, and then go to the smaller time frames. Now, if you notice where this is right here on the hourly. Now look at what happens on the hourly chart. So that's right here as it's crossing up. And then look, we make one more higher low on this time frame. So we did the exact same thing. We crossed above the 18 and it starts rising. We pull back and we make our higher low. Boom. Look at the pattern that follows. You see the strength? That's the strongest move this has made through that period. The dynamics of the move were very, very powerful there, especially if you're playing with hourly risk. So if you get in off this at 65, you risk less than $1 and it moves up $3 instantly, really within a couple days. By the way, if you're enjoying the content, hit that like button and also subscribe. Now, when you have that in your favor, where you have higher low, higher low, higher low, higher low. All right. When you can pull this off and you can find 4 consecutive time frames doing the exact same thing, you don't need indicators necessarily. The odds are really in your favor. And you got to get used to following the slope of this line. Now, I use an 18. If you did this with a 20, you'd probably get the same feedback, although I get a lot of questions as to why I use an 18, and a lot of it has to do with the slope of the line. I'm following the slope of this line. It's incredibly important. I want it to turn up pretty quick. When a stock makes a move to the upside, I want it to turn up as a stock crosses up and pulls back. I want to see that shift in the slope take place. So we've got 4 consecutive time frames that are trading near their 18s. All right. This is relatively close to the 18, relatively close to the 18, relatively close, and relatively close. You get 4 time frames consecutive doing this, and you essentially are trading in multiple time frames. You've taught yourself how to trade in multiple time frames without doing anything crazy or being any kind of a genius, really. And now, what I'll tell you is that if we add in the indicators, it can highlight some things. So it can show us some things that maybe we wouldn't necessarily see. That's why in my course, in my book, I add those in, because we do want to recognize which ones are showing the most strength from a momentum standpoint as they're crossing up and as they're pulling back. Sometimes, as you get more proficient in seeing the bars and looking at the bars, you can see it without the use of the indicators. And I do recommend you start out learning that. But once you have a pretty strong feel for how to read the bars, how to look at it in relationship to the moving average, how to incorporate trendline analysis into what you're doing, the MACD and the ADX are going to really pinpoint what bar you're going to want to get in on each of these different time frames. And when you start to combine them, you're going to start to see things that, again, the majority of the people that are trading really are not seeing. All right. This is 4 separate time frames. These are 4 different groups of participants. Some guys are long-term. Some guys are intermediate. Some guys are shorter term. And then you've got guys that are really micro traders. All right. So you've got these 4 different time frames, and they're all basically giving us the exact same feedback. Look for this. And I think this can really help you. And it certainly can help you understand how to get entries in multiple time frames.